Hello, everyone. Very good evening. Welcome, everyone, to our weekly show, AIKI Ab India Karega Invest. Normally, we meet on Friday, but tomorrow being a festive day, we are catching up a day in advance. So, wishing everyone a very colorful Holi. May you have a lot of colors in your life and in your investing too. So, interesting times these are from investment point of view, where if you look at news coming in from different feeds, giving you indication to invest in different asset class. Russia, Ukraine getting into a war makes a case for gold. Ample liquidity in the market makes a case for equities, and commodity pricing going up with inflation. Commodities looking very interesting. So, what an investor do at these times? At times, many of us may feel confused with our asset allocation. So, we thought, like every week, why don't we choose a topic which is very interesting, which is very useful from a long term investment point of view, and uh, that's the reason we thought of getting you a topic on asset allocation and investor biases, which will be handled by one of the industry veteran. And let me introduce and welcome Mr. Swarup Mohanty, who is from Mirae Asset Investments. Over to you, sir. How are you?
Yeah, Rishabh, thank you so much for having me and wish all viewers a very happy Holi.
Thank you so much, sir, for joining with us. It's a pleasure to have you here on our show, and I'm sure that next 1 hour going to be very interesting from investment point of view. And I would request viewers to take notes. Is somebody with 20 years of experience, 20 plus to more than 2 decades into the industry. He's giving his precious time to all of us, and let's make the most out of it. So we will be asking a question to Sarup sir relating to uh, investor biases and asset allocation, and he will give his view on the same. And then at the end of the session, we will take the questions which all of you put on our chat box. So we will pick a lot of interesting questions, and that also we will ask to our guest. So that will be, so today's format would be more like a Q&A, and we'll first start with the questions which we have got. So, sir, with your experience of more than 2 decades in industry, what do you feel? What impacts the most to an investor while making investing decisions?
Rishabh, it's an interesting question because a very loaded question. Investing is a journey, and as we start investing and take that journey, we realize certain facts about investing. And it's a very known sort of concept that the basic thing that one requires for investing in all asset classes is discipline. I mean, Indians in particular are fantastic investors in fixed assets. I mean, clearly the real estate and gold are great examples of investment behavior from Indians. Nobody in the world probably matches up to them. But when you look at both these investment behaviors by any Indian, the thing about them is being disciplined. You know for a fact that if you invest in a house, and there's very common knowledge for Indians that if you invest in a house, it will make money. And if you invest in gold, it will make money. These are basic conclusions of every Indian. Why is this? Because they've probably seen their forefathers and 2 or 3 generations earlier going through that same process. And when you look at that behavior, the first thing that comes out is that discipline and that ability to hold that asset class for a long period of time. And that is what is, I think, very characteristics of any investing journey. To keep discipline as the foremost factor of investing. And when you look at discipline, it means no emotions. It is very difficult for any investor to dissociate one's own emotions when it comes to investing. And somebody who conquers that and remains emotionless eventually becomes a better investor. So that's my learning over my last whatever 2.5 or probably almost 3 decades now of being in this market and investing personally and watching investors, is this ability to take away your personal emotions from your investments, make it as mathematically as possible. There's this great financial writer and orator called Carl Richards, and he has said something very, very pertinent, that there is the investment return and there is the investor return. And the difference is what he always calls is the investor behavior. And if one matches the investor behavior to the underlying investment vehicle behavior, the outcome is more or less beneficial. The reason why we made money traditionally in real estate is we married the investment horizon of that investment vehicle to your own. I mean, you're not nobody buys a house for a year or two. Nobody buys gold for a year or two. In fact, one buys gold for generations. One buys a house for generation. It forms inheritance. Now, if you form that, and that's a very unemotional way of life. If you just imbibe that behavior into any sort of asset class, and especially when you bring it to financial assets or financial asset investing, the result or the investment experience can be similar.
Very, very interesting. Investor return and the asset class return. I think a lot of us need to understand the difference between the two. So, very interesting, sir. I think once we understand this, then how do we work around it? What is the strategy? Keeping this in mind, what a normal investor should do to make sure that he's not seeing that gap between the two.
Yeah, that's the natural progression to the question. And that, see, like I said, the investing is a journey, and one discovers oneself in that journey. Why does one invest? Because there is some benefit or some reason behind it. I think the first thing that all of us learn, and we learn over a period of time, is that do we put that journey to be the most important thing? I mean, why do we invest, or is there a reason for us to be investing? Typically, again, if I reflect on the first discussion that we were having on say the requirement of a house, you need a house to live in, and when you buy that house, you practically know what kind of a house you need, right? And based on that requirement, you go on searching for a house. You don't go whimsically and say, okay, I'll buy a 5 bedroom house. It doesn't happen like that. You practically know what you have or what you need in your mind. So similarly, when you progress that to financial investing, do you have that plan in mind, which is most important? Or why are you investing? What is your goal to your investing? Simply put, do you have a purpose to that investing? That is, for me, the fundamental starting point for any investing. Because if you have a purpose for investing, or you know why you are investing and what is your goal for investing, with the kind of money you have, first of all, it is very important to then figure out whether that goal is viable or not. Now I need 50 lakhs and I don't have the means to reach 50 lakhs, then that goal per se is not viable. And that's something which one must keep in mind. The goal should be realistic. So till you don't know the goal, you cannot marry that to your present situation. Add to that the ability to take a certain risk. You make money in any asset class over a period of time. Do you have that period of time with you? Now you want a certain amount in 2 years, suppose. And do you have the money to reach that goal is something which you have to be very fundamentally clear about. So for me, the most important part is fixing this purpose. And once you fix this purpose, how you go about reaching that purpose is not very difficult to find out. Invariably, what happens is the fixation is on the journey, where to invest, which is the best scheme. That precedes the journey or the goal. While that is not the most important part. How do you make your investment journey a tangible journey is the most important part. And then once you make it tangible, the investment experience will be completely different. From what little I have seen over the last 2 3 decades, as I've said in earlier, is that more importance is given to the vehicle of investing rather than the reason of investing. Most often than not, and Rishabh, you'll bear with me when I say this, the
Yes.
most frequently asked question is, Swarup, which is your favorite scheme? uh, uh, you know that favorite scheme may not be required by the investor. Is that favorite scheme required is a question which one must ask as well. So once you fix the goal, then where you will invest becomes easy, not the other way around.
Right, sir. I think very, I would say, explain in a very layman's language. Everybody would have understood that one need to fix that purpose, and once you have that, everything falls in place. So, sir, now let's say I have the purpose with me, and I am standing to invest somewhere. So, what should be a approach? Somebody who's just starting investment, or probably in the early career phase, what should be his investment choices, those important decisions which he needs to take at this point in time? So how can you throw some light on those? Yeah.
Yeah, Rishabh, fundamentally, making money is not easy. That one should know very at a basic level. If you have to make money, you have to know how to make money. And if you have to know how to make money, you have to spend time on your money. I've met a number of people who do not know where they have invested. That's not right. It's your money, and if you know a little bit about the journey, it will help you. Not a little bit, a lot. So first thing is, this is a very serious business. This is not a business of fun and frolic. And people might say it's a business of luck. Luck is not more often than not, the knowledge of the journey favors the investor than the luck factor. It's not lottery. There is a science to it. So understanding that science means you have to give time to your investing journey. That is fundamental. If you do not want to give time, please go to a person who is a professional who will help you on this journey. I mean, clarify that in your mind. If you think you have the capability to do it yourself. If you think you have the capability but you don't have the time, that is also a factor. You can, in that case, take go to a distributor, advisor, or whichever form you want to go. But first choice is that: do you want to do it yourself, or you want to leave it to a professional? Point number one. Point number two is, once you find your own goals, because Rishabh, your life is different from my life, hence your goals will be different from my goals. So there
True.
is no one set pattern of investing. The investing pattern is based on your requirement, right?
Yep.
So once you've sort of fixed up your basic requirement, which are the goals, then comes the next part, which is creating that financial plan, right?
Yeah.
Which you can do yourself or you can go to a professional to do. Now, the financial plan then is divided into various investment avenues, which are then written, formed by what we consider is according to your risk taking ability. Now, here's something which I want to share is a fair amount of learning myself in my life. Your risk taking ability is a factor of your life also, and your risk taking ability is not a constant. Your risk taking ability changes with your life, and also changes with the environment around you. Just a few days ago, a year ago, the market crashed by 40%. Even pedigreed equity investors who had not seen 40% kind of a fall in just a month time will rethink. There's nothing wrong in rethinking. So the most important point is to acknowledge that risk taking ability is not a constant. Suppose I have one child, my risk taking ability differs from me having two children.
True.
So it's circumstantial and it changes over a period of time. So the asset allocation, or where you invest across different investing avenues, is a combination of your risk taking ability and your goal. Once that is formed, then you come to the next step, which I said was, the first concern of people: where to invest. This is probably the fourth or the fifth step, where you will invest, right?
Right.
That falls in line into your goal. Suppose my goal is, say, X, and the return requirement for that goal is, say, 6%, just for discussion sake. Then I can achieve that day 6% without investing in equity. right? But it is very important to know how much I have to achieve and what is the return that is required to achieve. Once you know this return, then you decide which asset class you take. Now, if you want to take 10 to 12% as I'm giving my own portfolio sort of expectation, I have a return expectation of 10 to 12% on my goals and mostly my retirement goal. Now, if my return expectation is 10 to 12%, I don't have to take the risk of, say, a small cap kind of an investing. That does not make me a lower investor or a high investor. I'm just catering to my goal. Why do I need to take that risk if my goals are being met by mostly large companies which are more stable and a little bit of mid cap? Okay, so that is the point I'm making. It does not make me any less an investor, right? I always give this example that my retired mother with pension invests in small caps because she has a pension. I don't have a pension. I'm creating pension. So our investing journeys are completely different. So it is giving respect to this investment journey. Now, once you form this plan, comes the most important part of the plan, and this is where most of the wealth is created and destroyed, is a periodic review. A periodic review is very essential to know whether you are on track of that plan. And you can fix that periodic review as per your advisor or your own thing. Equity, typically people review it more than after a year or so. It depends on every individual, right? Once that review is done, and it has to be done very meticulously in a very disciplined manner, acknowledging the faults or deviations from their path. If there are any deviations, if there are any corrective action to be taken, then they also have to be taken in a very unemotional way. If you get married to a certain investment avenue which is not functioning for too long, you will get derailed from your goals. So that review and rebalance, which is taking corrective action, creates maximum of the wealth. And if you do that dispassionately, periodically through your investment journey, more often than not, you will reach your goal in the right horizon, right? But the environments change. Because the environments change, this review and rebalance is very important. And that's the simple process. Is just go through that every year or every 2 years and see that you're on the right path. To give you an example, suppose 2018, Indian economy decided that it will go to 5 trillion. It had put a date. Now we know we are 2 years behind on that date. But we know we are 2 years behind on that date because we had decided we go to 5 trillion.
Yes.
If we didn't know that we were going to 5 trillion, we would be very happy on the path. So that is what a goal creates to you. It keeps you focused to your journey.
Perfect. So I think that was very interesting, knowing that you need to review it periodically to make sure that we take corrective action before too much is gone on the other side. Now, sir, very, very interesting thing related to this. Like many people feel that, oh, all this I knew already, okay, or probably I know this from a long time, but still there is something which makes sure, or which hampers the decisions or take the decisions in the wrong sides. So what is that element which even after knowing so much, even after uh, probably understanding the facts and figures with so much of clarity, where do investors go wrong then?
See, investors are human beings, and human beings are emotional. There are some set biases which tend to creep in, which is probably the biggest deterrent to remaining on your track for the goal. I'll give you a small example. Suppose you have to buy a car. Okay, your status of life will define as per the society which car you necessarily have to buy, because everybody is buying it. Is something which we call a herd mentality. So people will tell you that this fund is very good, you must buy it. Everybody is buying it, so I will buy it. But like I said, if your return requirement is 10 to 12% and everybody is buying some other fund which is not giving 10 to 12, maybe more, do you need to buy it at all? That's not your requirement. But since everybody is buying it, all the TV channels are saying, and everybody is recommending, when you open the newspaper, people say it's a great fund. Not necessarily that it's a great fund for you, right? So this herd mentality, or what we call, is one of the biggest biases which keep people away from your basic investment sort of track or goal path. Is a big deterrent. The point I'm making is biases are the biggest reason why people do not stay on track, and it's watching out for this bias because they creep in. It is very inherent for people to creep in. There is so much of information around you. Picking out that basic information which you need for yourself is very difficult. I agree. Then there is a Russia war. Suddenly you start, I mean, I thought there wouldn't be any war. Okay, I went on record saying that no, no, they'll talk, there'll be no war. Then suddenly there was that bombing. Okay, I said, okay, fine, now war has started. Somebody said, what if there is a nuclear war? I said, what are you saying? 2022, will there be a nuclear? Suddenly the newspaper said, ki, what if the nuclear, this thing is, bombed? Anything is possible. When those things happen, inherently, you're bound to get in some of your biases. But again, I bring back that point that if you are in control of your bias, because that is what you are in control of, you are not in control of whether there will be a bombing in Ukraine or not. But invariably, you spend most of your time in thinking whether there will be a bomb in Ukraine or not. Okay, suppose there is a bomb in Ukraine. That is between those two countries. Are you deciding what you will do, whether there is a bomb or not? That is your control. And that is what is called eliminating bias. So if one can eliminate bias, one can be a phenomenal investor. If you look at any great investor, what they have brought to the table is elimination of bias.
So that means an investor need to look beyond what is visible to him so that he can ratify his investment decisions. Is that so?
Rishabh, I didn't get you. I was
So,
not able.
so I was saying from an investor point of view, so what is clearly visible, like from the news, from the information, there is a case to go beyond that to take decision for his investment portfolio so that he can remain on course.
Yeah. So I think one of the best examples is to go by some of the past. I'll give you my own example. Suppose I had gone through the 2008 2009 financial debacle, and at that point of time I was trying to figure out my own risk profile, or how should I approach investing in the markets. And I had seen that there was an aberration for which the markets had fallen. And this time around, when the markets fell, I used that knowledge to stay invested in the market. And but if you look at broad investor behavior, this time, especially through the SIP route, there has been very little SIP stoppage in the industry, clearly defining that a lot of learnings of the past, or a lot of biases which they had in the past, have been corrected this time. And this time, if you see the reason why these SIP investors are piling on even more money, because suddenly they have realized the benefit of catching the entire bottom of the market. And that happened because you did the simple thing of just staying invested in the market. So once you go through one or two of these cycles, you grow as an investor, and that always leads to a better investing behavior. And then I'm keeping on repeating the word behavior, because if somebody would have stopped the SIP during this, look at the kind of loss of wealth that would have already happened in everybody's portfolio. So remaining true to your investment plan and staying the course, and understanding the nature of each asset class, and understanding that volatility is a friend of you. It takes time, and once one does that, then one crosses over to becoming a superior investor.
Perfect. Now, there is another bias, I think, which we regularly read on this thing is confirmation bias, I think, which so
Yeah.
happens when people are looking for acceptance from the information probably we are looking forward. So how do you define that in investment world?
No, I think it is very natural that you look for confirmation around you. It is about every choice. I mean, just look at a shirt you buy, then you look at your wife. Oh, is this shirt correct? If she says yes, then you feel it's the right thing that you've done. And similarly, when you are doing your investment journey, sometimes this is a very natural sort of extension of behavior which happens. It's the tendency to seek information that supports your own belief. That I think of this thing, okay, I'm not confident. If five people tell me that this is right, then it is perceived to be right. Whether it is right or wrong, then you don't care. But when you look at investing, more often than not, this is avoidable. Because what happens, again, I bring back the simple discussion that Rishabh, your life is very different to my life. What might be good for you may not be required by me,
True.
right? So if I am looking for confirmation from you, it's fundamentally flawed,
Yeah.
right? That is why we often say go to a professional advisor. Now, for the professional advisor, it is also very important that they keep their own personal biases out of the client's portfolio.
True.
What is right for the professional advisor may not be right for the investor. So a good advisor fundamental role is to keep his or her personal biases out of the client's biases. They're two different journeys. So if you look for confirmation from people who are sharing your own journey or similar journeys, there's a fair amount of what can I say, righteousness in that. But invariably in a personal investing journey, this is highly avoidable, is my opinion.
Perfect. So that's so important. Now, what we have seen, sir, from 2020, since the fall, market was one directional till almost like a couple of months back. A lot of new investors have become very, very, you can say, they feel that they're becoming investing experts. So, based on this, there are a lot of biases which seek in. So, can you just throw some light on a couple of them? Yeah.
Yeah, I think the biggest bias that happens in such markets is what we call the recency bias. And typically this is not just market. If you look at the flow of funds, the importance that is given to what has happened in the recent past is always a big factor in every life decision, not just investing. And in investing, when we look at selection of funds, the past year return is all that matters. I can prove it to you by the industry flows. Now, when you look at the industry, when you look at fundamental mutual funds as a investing tool, the fact that the fund tells you that past performance may or may not have any correlation with the future is what is against this recency bias. When you look at any category which has performed very well in the past, invariably that performance belongs to the investors who were invested then. That may or may not be the return of the investor who's coming in now. That investment return is already gone.
True.
And that's what happens to a lot of investors who come in when you see a stellar run like this, and that's what we always warn against. That don't give that. See, there is an importance which should be given to the performance or the behavior on of an asset class. That is a weightage, right? In the recency bias which creeps in, that weightage is goes up higher, and it the what can I say, the horizon of which you select this asset class gets very short.
Sure.
My humble request to all investors is to broaden that horizon and then see how that asset class or that investing vehicle has performed over a period of time to give you the basic benefits of ups and downs. From that, you will know the characteristic of that product or that asset class. For that, you cannot make out how it will perform in the future.
True.
Now, understanding how it will perform in the future requires far deeper knowledge, far deeper time from you. Going deeper into the basic characteristics of that asset class. And again, I repeat what I said in the beginning, spend some time in understanding that. It is doable, it's no rocket science. But spend more time than just the recency bias that has crept into you already. And then the biggest thing that one should guard against as a new investor is the recency bias.
Perfect. Now the next one, sir. This is coming from my personal experience. I have seen a lot of my friends or immediate family, whenever they have to churn their portfolio or need to take some decision, they think that, okay, this is the stock or this is the folio which is giving me most profitability, so let me exit this. And somehow they hold on to something which is giving or putting it in red from last 1 year or 2 year. They feel that this will go up sometimes. So why do this happen with most of us?
See, first of all, there is a loss aversion in all of us. I mean, if I ask you which are the products you made money, you may or may not remember. But if I ask you which are the products where you lost money, you will tell me कि नहीं boss, इधर मेरा loss हुआ है. So basically people remember their losses, and more than it's a written fact. It's a, something which is researched and all. So, but that is deep rooted. I mean, I'll give you a very simple example. Typically, we in our investment journey, and correct me if I'm wrong, we tend to punish the performers and stick to the laggards. Typically, if you go to any family, and I'm just making a generalized statement, I'm not saying anything against anybody, but if the father has 3 or 4 kids, most of the money is kept for the kid who is not very bright, because the father believes the bright kid will, you know, fend for himself or herself. This is a very typical thing of how a behavior happens. And similarly, it is extended to investing also. If you have invested in 5 funds and suddenly you see a spark in 3 funds, you tend to redeem those 3 funds first than the others, or the next money need not go to these funds, while basic unemotional investing says otherwise. Your performers need to be rewarded and your laggards need to be punished. When I reflect on that review process, and when I say that keep emotions out of that review process, it is this: fund which has, or any investment vehicle which has helped you in the past, more often than not will continue to help you in the past, because the processes of that particular investment vehicle or the fund would have been far superior to the funds which have not performed. Just keep the recency bias out of it. I'm talking about a longer horizon of those products. Now, if you just do that review unemotionally, then you would probably award the performers more than the laggards. And if you punish the laggards, then your portfolio becomes more efficient. It is difficult to do because you invested 10,000, which is looking at 8,000. And here is something which is 10,000, which is standing at 12,000. How do you sell that 8,000? More often than not, people will say, let it come to 10,000, I will redeem. But trust me, the 12,000 probably will go faster to 14,000 than this 8,000 to 10,000, right? So punish in that review, take the unemotional call and reward the performer over the laggard.
Perfect. So we have seen a lot of biases of availability, recency, confirmation. So apart from these biases, is there anything else as an investor which we should keep in mind so that we are on our course to our investment journey without any issues?
Yeah, I just wanted to leave behind one thought, that investing is not very complicated. Investing is a very simple journey. Guys like me will come and tell you that it is complicated to make our importance greater in front of you. Simplify the journey. Marry your investment to your own life journey, and every possibility is there. Trust me, there is a product for you out there which will cater to your journey. There is a product. Find that product, and then take the journey with the product, like you've taken, say, with a house. There are times, if you look at Mumbai, excepting this COVID period, for last 5 6 years, the properties prices had moved anywhere, had not. There was a time correction. You didn't have anybody saying that, okay, my house has not moved in value, let me sell it. Doesn't happen, right? So similarly is the journey with financial assets. Once you've picked up a good asset which you think is right for you, take the journey with it. Now do a review. If it is on track, fine. If it deviates over a period of time, take the necessary action. But keep the journey simple. Don't spread yourself too wide. On your asset allocation, run a conviction call rather than saying that I will have 20, 30 funds. It doesn't work. Then who will keep track of those 20, 30 funds? you know Simplify it as much as possible, and do the review and rebalance, as I said. But build a good strong plan for yourself. It is not a very tedious job to form a plan. Yes, it is a tedious job to remain disciplined. Again, I'm keeping on harping on the it is impossible to remain disciplined when so many things happen around you. But if you can just control the controllable, and just remain on what you can control two things. One is how much money you have, how much money you can invest. It is never about how much money you have earned. It is always about how much money you invested. Right? Once you clear off this basic uh, uh, you know basic requirements, I think investing is not a rocket science. I just read a very interesting book called The Psychology of Money by Morgan Housel. It's a very interesting book, and that I picked up something very nice. And he said, find your enough.
Yeah.
Everybody has an. The problem is that enough keeps on changing. If you have the ability to keep your enough as it is, your life is not an issue. you know Say, when I was young, I'll tell you, give a very practical example. When this entire whole thing of cars changed, it changed by Maruti. There was a Maruti 800 which came, right? Now, if we guys come and tell you that inflation beats asset, do the 7% inflation rule versus the cost of the Maruti 800 that has happened. It has not beaten inflation on cost. Problem is not Maruti 800 not beating inflation. Problem is now you don't want the Maruti 800. Be very careful of lifestyle changes, because the problem that brings to your portfolio is a lifetime change. Life, your lifestyle changes. So if you are disciplined and you can control your lifestyle changes, nothing can stop you from being a good investor.
Perfect, sir. Thank you for summarizing it so well for all the audiences out here. Now, before we go to the questions which are coming from the thing, you were mentioning about books on investing. So, one of the viewer also posted a question: what are those good books which people can read? Probably two, three names from your side, if you may. Which investors, or probably a beginner investor or somebody who's not a very this thing seasoned investor, could take up and get some insight from it. Yeah.
Yeah, I think, some basic books. I was very lucky that, very early in my life, I could read a book called Rich Dad, Poor Dad by Robert Kiyosaki, which sort of changed the way I approached this entire investing, because it sort of, differentiated what is active income and what is passive income. You can create passive income. It is good for you. That happened at in my early 20s. I was very happy with that book. I was able to read Passports to Profits by the great Mark Mobius. It gives me an insight to asset allocation and then basic fundamentals, or the thought of a great fund manager, of how he approached investing. That's led a very telling sort of impact on my life. Recently, I read, Monica Hallan's Let's Talk Money. It's a very impactful book for me, because it said something that, you have many bank accounts. Why don't you put a purpose to each bank account? You can have a spending account, you can have an investing account. So on one account you transfer money which you will invest. I thought that was a very simple way of approaching investing. It really made sense to me. And Morgan Stanley, Housel's Psychology of Money, of finding your enough, because everybody's enough is different. And then he sort of gave you the caveat of, be very wary of that enough changing. So these are pitfalls of investing, which these great authors have put together in a very simple format. And it's about investing in your life, and but more important, I think, Google always amazes me. If I have any doubt, I write that doubt on Google, and it is very fascinating how my doubt in that same wording is the doubt of so many people in the world. So if you have any doubt, everybody carries a phone. Just write it down in the Google on in Google, and what will come out is a pleasant surprise. So there is an answer, and just keep on finding these answers. And my boss of mine had told me a very simple thing that success to life is read more, meet more. If you meet more people, you get to understand more about life, and if you read more, obviously the knowledge quotient goes up. So these two are basic fundamentals of life which I always carry.
Awesome. Read more, meet more. So I think our viewers have also got a new mantra to follow and some amazing names of the books. So I think next 1 month they would be busy with reading all this. So thank you so much, sir, for sharing those names with us. So moving forward, there are a few more questions which our viewers have shared with us. So just taking one by one. The next one is, uh, as you said, everybody's life is different. So I'm sure the risk taking ability and the risks also depends uh, from person to person. So how do people take those some basic steps to minimize their own risks? So if I have to
Yeah, I
minimize
think
my risk, yeah,
yeah, Rishabh. I forgot mentioning one part which I'm happy this question came up. There are various risk profilers online. For
yeah,
all new investors, I would really request you to go through a risk profiling question mark questionnaire. It's like a psychometric test. You'll probably come to a conclusion and get a you know tangible of what this discussion of risk profiling is. And if one can do that periodically over a period of time, if there are certain changes in your life or there are certain changes in the market, if you can go back and then revisit your risk profile, and while doing the risk profile, be ruthlessly honest to yourself. A lot of these answers can come out as to how much risk you can take, how much risk you can minimize. And asset allocation, I think, minimizes risk the best, because what happens is, typically I've met these and I followed that very classical thumb rule of the age. Some people don't, but I do. Like, your age is your best risk profiler. Say my son is 23, then 23% of his overall investments are in debt, and the balance goes into equity. So as you progress in life, your debt component goes up, and the equity component comes down. This used to be something which we used to practice earlier, but what has happened is you started living longer.
yes,
So, because of that longer, and you typically say average age is now crossing 80, so add 10 to that. Or minus 10 to the debt part, and do that. That's a better way. I approach it like this. Suppose I'm 51, so I minus 10 from that and come to 40. So 40 is my debt, and the rest becomes equity, because earlier I was thinking I would live till 70, 75, but today 70, 75 is not the age that one will live to, hopefully. But add to the fact that that last end of your life you don't have income, and
yes,
not having income, and leading a life, it cannot be more traumatic. So I think what people need to understand is that today, with extension of your lifespan, your requirement for that retirement kitty has just shot up, right?
yes,
So be very serious about this part of your requirement, in accordance to the extension of that lifespan, is something which I'd like to leave behind. So this has a bearing on the risk profiling,
yes,
because if you are going to lead longer and spend a substantial part of your life without income, then your passive income has to be stronger. That is the
yes,
amount of money you will have when you retire, when you stop earning, right? Here I bring back the greatest learning that I've had from Robert Kiyosaki, because he's the only one who's defined what you call the word wealth. And think about it, and this is going out to all the new young investors is that what is the definition of wealth? He says ki if you shut your eyes and think of your amount of money that you have today, you decide with that money how much time you can survive is the amount of wealth that you have. So people typically look at wealth in a currency terms. He's put it in a time term, and which is a very scary thing. Suppose you have say 10 lakh rupees. How long can you survive for 10 lakhs without income is something which everybody needs to think about. With that, I think somewhere what I'm trying to tell people is that once you know your risk, but when you look at the lifespan that you have, maybe some of us will have to push that risk profile a bit and invest more in growth assets than one typically should do mathematically. It's a more practical thing to do.
I'm sure a lot of our viewers would be closing their eyes and just visualizing how much wealth they have now. So
It's a scary
yes, I
thing, let
think
me tell you.
it's a
I
scary
got
thing.
scared at 23.
Indeed, it's
I
really
realized I
scary.
was not surviving a month.
So true. Yes, I will take another question. So there is a viewer who asked, is the periodic review only for direct stocks or even for mutual funds? And if it is, what kind of review period ideally people follow?
Your review is on your total portfolio, not
Okay.
on a particular stock or one part of your portfolio. You look at your total wealth vis-a-vis where you stand on the journey on the requirement of that wealth. Suppose I have a 10-year journey now, I'm say 51, I have to retire 10 years later or 9 years later. I have a target for that retirement. So every year I review where I stand on that target. Now what happened is I always say this is that for some reason, and everybody has a very valid reason not to invest, I didn't invest for the initial part of my life because I tried to fulfill my fantasies which were pent up. So I spent much more than what I should have. And hence, the pressure on me to invest now is far higher to reach my goal. Now, suppose the markets have corrected, say, 20%. I then know that next year I have to invest 20% more. So I have to cut down on other places and find money to invest more here because I have to be on track. If I'm not on track, then that scary part of Robert Kiyosaki comes into my mind. And that I could have deviated, Rishabh, at your age, but at my age, I don't have time of earning income, right? I have to convert this salaried income into investments so that I lead a good retirement life. Otherwise, if you look at the retirement census of 2011, I'd really like to people to read that census where nearly 70-80% of people, just 10% of retired people have pension in India. Think about that. So, to answer the question, I do a yearly review. I would be happier doing a 2 year review, but since I have just 9 years left of my earning life, and I don't wish to do a salaried job after that, I hope I am right on this one. I have to do a yearly review, but younger days you can do it a little later, is my personal opinion.
Perfect. I think the viewer has got his answer. Now, another viewer says, for beginners, which is the best way to start investing without falling for any kind of FOMO?
Yeah.
Because with equity markets going like this, a lot of people feel that they might get into a trap. So, how do we control? I think one of the biases you mentioned that. Yeah.
So, people who felt they had missed out this huge comeback of the market, saw the market correcting nearly 15, 18, or 20% a few days back. People who thought it will correct more, the market is back another up 8, 10%. We are almost reaching the peak now in the next, whatever, if this continues. So, there is no good time or bad time to invest. The best time to invest is when you have the money, right? It is futile to time the market. If you've got it right the first time, it is beginner's luck. Trust me on this one. And next time you invest, I you can track me. I'm on Twitter and come back to me. I will be held responsible. Please understand one very interesting mathematics which I have not been able to actually understand till now. For 50 rupees to go to 100 rupees, you need a 100% appreciation. For 100 rupees to go to 50 rupees, we are talking about that same 50 rupees, you just need a 50% fall. Which is easier? Okay, you decide. So when you invest, please keep one thing in mind, is that preservation of capital is also a big factor of investing, and that's where your risk profile comes into play. Can you take a 10% loss and be okay with it? Can you take a 20% loss and be okay with it? The way I approached equity investing is, I said, okay, this is the amount. If I lose, it will not going to impact me much. So I started investing in that much. At one point of time, it used to be 2,000 rupees a month. It went up to 5,000 rupees a month. At one point of time, it became 15, 20,000 rupees. I was telling myself, if this 20,000 goes, I'll be okay in my life. So that's one way of approaching it. The other way, which is a great way of looking at, any asset class, is to first understand the asset class, because every asset class comes with its own nuances. Today, when you look at the equity markets, you have three way of investing. If you think you have the ability to, look at balance sheets and find out stocks, I would really, urge those young people to do that and take to equity investing in a direct way, and see for yourself the wealth creation that you can do. Back yourself. That's my first submission to the young. It is not, the young are brighter. The knowledge available to you is far more than what it was available when I was young. If you have the time, but it requires time, then do it yourself. If you don't think you can do it, you have two ways of doing it. One, come to a professional fund manager, an active fund manager, who invests on your behalf. And trust me, there is a fund out there which will cater to your requirement in this industry. Find an advisor or a distributor if you don't want to do that yourself. If you want to do it yourself, you can Google. Okay, and platforms like Groww are incredibly efficient and fantastic from the efficiency of this process. I'm not saying that because I'm on a Groww platform. The figures which Groww is throwing up in the market is testament of this, right? That so many investors are taking to the platform. I'm just reiterating that figure. I'm giving you data, right? Otherwise, there is another third way which is emerging in India, is that to buy the market initially, right? There are two things which happen. When you buy the market, you buy the beta of the market, which is the behavior of the market. When you buy that market through an index fund or an ETF, you understand the nuances of the market. That's a good way of starting. What the active mutual fund aspires to do is to give you slightly better returns, or alpha as we call it, over these markets. And that is why the active mutual funds charge you a little higher, right? So these are the three ways of investing into equity. On the debt side, there are a plethora of funds across the risk spectrum suiting your requirement. Make a mix of two and form your portfolio. Sometimes what is happening today, because of the categorization of mutual funds, you are getting some exciting ideas in the ETF or the passive fund route, because the categorization funds have laid down these are the types of funds that are available. You can do your core portfolio through, say, active funds and add some fantastic ideas on the passive side, or do the reverse also. Okay, fine, I will invest in Nifty 50 and take some good ideas on the active side and build the satellite. There are n number of permutation combination possible to form a portfolio, but the combination which marries your portfolio to your goal is the right combination for you. Spend some time in this before you come to investing. Do your homework, understand what you're talking about. See, there is a risk to investing, there is an equal risk to not investing. At this time, the risk to not investing is probably higher because the need for money is higher. There's no denying the fact, right? There is a risk to investing in equity. There is an equal risk to not investing in equity, right? Both stories are there. But a good investor is one who knows these risks and invests in what he or she is comfortable in, right? And there is nothing wrong in me saying that, boss, I don't want the volatility of equity. I will invest in debt, which is fine. Then the returns of debt should be acceptable to you. If that is fine, if you don't want to come to mutual fund, there is a bank FD for you. But the bank FD return is this much. So if that is okay with you, be there. But invest in something which you are comfortable with, because that is how you'll sleep well.
All right. So we have taken all the questions from the investors. It was, I think, a lot of new learning for me, and I'm sure viewers also would have enlightened with a lot of knowledge which you have shared from your experiences over the life. So before we wrap up for today, sir, final note from your side, two, three things which just summarize your today's talk, which you want to highlight once again. Yeah.
See, it's a very simple thing, Rishabh. When you are investing to create wealth. There was a time that the growth asset was, say, the real estate. There was a time when the growth asset was gold. If you take the top 200 people in the world, or the richest 200 people of the world, or the richest 1,000 people of the world, their investment is in the growth asset of today, which is equity. If that is how they are creating their assets, how can we be different? And India is at a fantastic position at this moment. Post COVID, it is advantage India. In the next 5-7 years, India sort of got back some of those disadvantages which has crept in before COVID. Invest in this growth assets, invest in a country which is growing well. You also have avenues of investing abroad. The plethora of choices for an investor today is available there, but you will only create wealth if you invest. And the best time to make money, or the best time to invest, is when you have the money. So don't overthink. Stick to your asset allocation. Be as unemotional as you are, and please don't try to time the market. The market is smarter than all of us put together. Respect the market, and if you respect the market will come back and respect you. And the last thing I'd like to say, take care of your money. If you don't take care of your money, the money will not take care of
Yes, that was straight from heart and from a person who has spent good amount of time in the market, seen many cycles. So I'm sure today's conversation was really useful. So take these quotes or piece of wisdom to your investing life and make sure that you follow them to the T. And I'm sure that 5 years, 10 years down the line, you will remember these words and you can say with proud that yes, those defining moments have changed my investing pattern. So with that, wish you all the luck and wish you a very good evening. Yep. So thank you so much for joining with us, and really had a great time conversing with you, sir.
Thank you so much, Shiv. It was my absolute pleasure, and thank you for having me. And wish everyone a very happy Holi.